Hello, and a warm welcome to yet another informative episode of Market Views. If it's your first time tuning in, I believe you have missed out on our prior episodes, so please do join us on our coming episodes. We are in March, approaching the end of the first quarter of 2025, and we find it prudent to just do a monthly review of the month of February, look at Econet's annual dividends for the year ending 28 February 2025, is always looking to Simbisa's half-year financials, just taking into account that it's one of the most liquid counters on the Victoria Falls Stock Exchange, and basically also its market weight of 16%. So there's no any other better way to look into these figures than just sit down and talk out these matters with some of our fellow analysts. So basically on Market Views, we talk about all things equities. That's having a look at the Zimbabwe Stock Exchange and the Victoria Falls Stock Exchange, mainly analyzing listed counters, as always look at other economic indicators that have a direct impact on our stock exchanges. So I'm your host, Kudakwasha Taimo, and joining me on set today, I have Ian and Desire. Gentlemen, welcome on set.
Thank you. Thank you for having me.
All right, it's our pleasure. So I'll begin with you, Ian. Looking at the Zimbabwe Stock Exchange, at the beginning of 2025, it had a market cap of 1.7 billion, and that was after there was an 18% decline on the month of December, following a downtrend which began around September upon ZiG devaluation. And for the month of January as well, we also saw a further decline of 11%. And at the end of January, I'm sure we also communicated with our viewers of how major blue chip counters were now trading at their low prices compared to the historical averages. And we are talking of the Seedco, Delta, Econet. And for the month of February, we actually saw the blue chip counters rebounding and driving the market cap upwards. We saw the ZSC increasing by 6% for the month of February. And perhaps we need to show our viewers, those are the top 5 gainers that we had and the top 5 losers. And also what's notable there, it's also Delta and Econet. They were not part of the top 5 gainers, but they also drove a rebound that we experienced in February, because Econet actually increased by 16% over the month of February, and also Delta increased by 24%. No, it's Econet that increased by 24% and Delta by 16%. So looking at these figures, as we are now approaching the end of the first quarter, what are your views on the activity on the Zimbabwe Stock Exchange, on the rebound? Are we likely to see this continuing for the month of March and also for the rest of the year? Generally, what are your views?
Okay, thank you, Kuda. It's my pleasure to be here. So looking at these two counters, if we take a look back to January, Econet and Delta contributed 70% of the value traded. Then moving on to February, they both contributed about 83%, with Econet commanding 50 and Delta commanding about 30 something percent. Yeah. So generally these two counters actually drive the liquidity on the market. They're the most liquid counters on the market, and I think moving on to the end of the quarter and during the year, we're just going to see a lot of activity in those two counters. They command, I think, about half of the market weight on the ZSC itself. And I think we are going to see an improvement in the share prices as we approach earnings season, because most of the counters that have a year end of December 31, we are going to receive their financials soon enough. I think around late March, we're going to receive many of those financials. So I think we'll see a lot of a rise in the share prices.
Okay, thank you. And also taking a look that Econet's full year financials end in February, and also Delta's full year financials end in March. So yeah, we are most likely, and then we are eagerly waiting to look at those financials. And as we have said, obviously they will drive a lot of activity. So Tim, for the benefit of our audience, we can also just show them the graphs for trading activity on the ZSC. So I'm sure you actually beam for our viewers right there. So over to you, Desire. Now let's look at the Victoria Falls Stock Exchange. So the Victoria Falls Stock Exchange, it began the year with a market cap of I think around 1.28 billion. For the month of January, the market cap declined by only 1%, but for the month of February, we saw it declined further by another 6%. And in terms of activity, only a few counters drive market activity. So now that National Foods is delisted, we are now talking of Simbisa in scope. For the month of February, we saw FCB driving total turnover for the month, for the ones of trade which took place of around 40 million that exchanged hands on a single trade. So in your view, why are the only few counters being driving liquidity on the foreign denominated bonds, and what are your sentiments going forward? Are we likely to see improved activity anytime soon?
Okay, thank you so much for the question. Well, maybe before I answer your question, it will be important to really discuss why the Victoria Falls Stock Exchange was put in place first.
Yeah.
So one of the major reasons is that it was to act as a conduit for portfolio investment, to attract foreign direct investment, and the other reason was to, to sort of like adopt the J's and Gains model of building the offshore financial center around the stock market, whereby you initially start with the stock market and then you build the surrounding infrastructure. But in terms of activity, like you said, last month there were only 3 winners, FCB included, and there were currently 13 counters, right?
Yes.
So it shows that there isn't much activities because the stock market largely relies on those huge transactions. I think African Sun also had a block trade of 51 million shares. So if they were to see activity, there's a need to have more companies listing on the stock exchange. Okay. And some of the factors that might be affecting activity, they might have to do with the preference of investors who still prefer ZSC over Victoria Falls Stock Exchange, because of its track record, and it's easy to, the liquidity is actually good compared to VFX, because there's already someone who's ready to exchange shares, so it's easy for investors. And also when it comes to foreign investors, I'm not sure if there's that sort of assurance in terms of repatriating their profits. So if maybe we are to ensure that the policies really support that, it might become easy to see a lot of foreign investors coming through. And also I think there is a need to have incentives to promote retail investors, because most of the transactions there, I think they are institutional investors that are trading there. Yep. Talking from experience, most of my friends that I usually talk to, they're just saying, I know what, they are very reluctant with the trading there. And the issue that the currency is not clear, you might wake up with a different currency there. So the risk is really high. But if we were to see more activity, I think having more counters which enables investors to have a diversity in terms of portfolios, I think that would really help to improve the activity of the stock market.
Now, as you have said, I was also actually looking the same at the RBZ directive for all local companies to report in ZIG. So obviously, I'm just sort of like reinforcing the point that you made, the risk of currency. Because now we are looking at counters that are trading in USD, but being mandated to report their financials in ZIG, which is likely to reduce investor confidence and also promote transparency and enhance activity on the bourse. But well, now let's look at Econet. So yeah, Tim, you can also beam that slide with Econet annual dividends for the benefit of our viewers then. So I'll start with you, Ian. We saw Econet being consistent in how they paid their quarterly dividends for the whole year ending 28 February 2025. So the total annual dividends for the year ending 28 February 2025, we actually saw that it was 1.76 US cents. And being extreme conservative, we saw that it had a yield, a dividend yield of around 13%. Man, that's huge. Taking a look at other asset classes, even properties itself, which is widely seen by the being preferred, whether be it by portfolio managers or investors, few properties can actually give you a yield of even 10% in our local market. But of course, yes, it might be subjective, taking into account that we don't know how much dividend might be issued out in this current year. But let's just take a look at that annual dividend of Econet, and we just want to hear your views. What are your thoughts in terms of the financial health of the company, investor confidence, as well as the future outlook for Econet?
Okay, thank you, Kuda. So when the Econet dividend announcement, it brought about an unexpected high dividend. Many people were not expecting to see such an high dividend. So it actually signals that Econet has strong financial health in terms of cash flow generation. They have extra cash, which they decided to say, let's give back to our investors. So I think also what brought about this extra cash is from, if we look at 2021, 2022, Econet had a huge debt burden. And when I looked at the current financials at the moment, I noticed that the current ratio actually improved from around 1.1 to 3.1. So that's 3 times cover. So I think that was a welcome thing by the investors. When the dividend announcement was made, we actually noticed also that the share price improved from around 311 cents to around 350 something, 13% increase
in a day.
And currently today, as of yesterday, the price was around 361. So this was also accompanied by a volume growth. So when you see share price and volume moving in tandem, it shows that there is some investor confidence that is actually boosting the share price, and shares are exchanging hands. Going forward, I think also it's a good thing because as investors, we always look at the return of the company. So that at dividend yield of 13%, I think we are going to see a lot of people trying to get their hands on the Econet shares.
Okay, thank you. That's actually quite insightful. And on that same note, Desire, I just want to hear your views also. Something that we didn't put on some of our graphs right there, but I think it's notable for our viewers to also take into account, comparing full year ending February 2025 and last year. We also see an increase in those annual dividends paid. Last year it was around 0.55 US cents, and for the annual dividend for the year ending February 2025, we saw the dividend actually being 1.76 US cents. And for the prior the 2 years, for 2023 and 2022, the company has been on a hiatus in terms of dividend payments. So I just want to hear your views also, whether you agree with what Ian said or we have different views.
Well, I think I share the same sentiments with Ian, because prior to last year's dividend, I think Econet had last paid a dividend in 2021. Yes. So this shows that the company is currently enjoying good profits, and they have actually good they are generating cash flows from operations, and this can also be backed by their performance, because the data services actually increased by 56%, whilst the voice traffic increased by 36%. So in terms of revenue, the data service actually increased to 47%.
The contribution of data segment to top line.
Increased to 47% from, was it 38%?
Yeah, true.
But the concern would be then to say the voice revenue actually decreased from 49 to 41. So this might be a sign that customers, they are shifting the taste. They're now preferring to use data other than voice. So the company might also need to invest in data technology. When Starlink came, everyone was like, Econet is going to be affected. Yeah. Maybe it's too early for us to comment on that, but I feel like with the level of premium service being offered by Starlink, if Econet is to really stay to have that competitive edge, they need to invest more in that technology. So yeah, currently the company is performing very well, and shareholders really deserve that dividend, because investors, they are concerned with the value in terms of their investment, and that value is shown by receiving dividends.
Interesting. Now let's look at Simbisa Brands, right? We saw a year-on-year 7% surge in the top line, and we saw the group reporting revenue of 157 million, and we saw an increase in terms of the store counts from 680 to 732 for the period from December 2023 to December 2024. So let's break down these numbers for our viewers and explore what this entails for the company performance and the growth trajectory.
Okay, thank you, Kuda. So Simbisa has been on a really aggressive growth strategy. If we take a look from 2020 to 2022, the company has grown by about 30% to date. And speaking to the numbers, so the top line revenue was influenced by a 5% increase in customer count. Deliveries increased by 24%. Average spend by consumer was about 2%. So all those numbers fed into the top line we see. And also from the previous analyst briefing, they also gained from the value, the currency, the Kenyan shilling actually gained value by about 13%. So I think the company has managed to actually capture market share. I think in Zimbabwe, I cannot say they have any competition really. They enjoy almost about 80% of the market share. Yeah. So this speaks to the current numbers we are seeing.
Yeah.
And also the company also has managed to increase their number of stores, capturing almost every customer at every corner. If taking a look where I stay, if you look at Borodo Pomona, you have Chicken Inn. In another 100 meters by same levy, there's another Chicken Inn, catering to different customers.
No, that's actually interesting. Now, Desire, looking at that top line, 157 million, 110 of the 157 million is actually the Zimbabwean market. And on the analyst briefing that we attended last week on Friday, we actually heard the management saying that they are actually on a verge to increase deliveries in our current market, because there is a huge untapped potential in that regard, taking into account that in markets such as Kenya, the annual deliveries of about 3,500 a day. So what does this entails in terms of the Zimbabwean market towards the group?
Okay, well, I think we can easily draw that Zimbabwe is Simbisa's cash cow. So, but there are also factors that you need to consider. It's either we are overpriced, their products are overpriced here in Zimbabwe. Would also have to do with currency or inflation that is there. But I think it shows the strong brand presence here in Zimbabwe, and also customer loyalty in Zimbabwe. Like he said, I don't think Simbisa really has competition in
Competitor.
Zimbabwe in terms of real quick service restaurants, because they are actually the ones that are at the top. But you know what? Like you said, they've been on an aggressive expansion. We need to see, is it sustainable?
It was in December alone we saw them opening, I think, around 17 counters, right?
Yes, 17 counters.
Because we might end up facing a scenario whereby they are putting pressure on cash from operations. And the such expansion we've seen, like with other companies, for example, I would refer like to OK Zimbabwe. They had a refurbishment exercise from 2021 around there. But from what's happening at the moment, we can actually see that maybe the company did not have the capacity to really expand. So this aggressive, expansion in a market like Zimbabwe, where currently a lot of business are struggling, I'm not sure if it's sustainable. I'm worried about that.
Okay, I think just to add, also we have to notice that 80% of the top line was in USD. So I think the company has managed to navigate the local currency conundrum that a lot of businesses have been facing in Zimbabwe, and managed to actually mitigate against currency risk.
Now let's conclude, gentlemen. At the beginning of 2025, initially what was pronounced as fast food tax was 0.5%, but it was actually increased to 1%. And the plastic bag tax of 20% was also introduced. And the group, to counter these, they are saying that they want to absorb the cost by not passing on the cost to the customer, but also by increasing the customer base. That's how to counter the 1% fast food tax. And to counter the plastic bag tax, they want to transition also from plastic to paper. So I just want to hear from you just one statement on how feasible this is on our current market environment.
I think this will be actually successful in the short to medium term. In the long term, it will depend on the cost mitigation strategy of Simbisa, and actually how sustainable will it be to increase their volume growth. Because if you look at the Zimbabwean market, the consumer is very price sensitive. It's a market where we have price elastic demand. So, but if they manage to actually manage their costs, I think they'll capture a lot of counters, and we'll see an increase in customer count in their offices, because Zimbabwean consumers want cheap, affordable goods. So I think it's a welcome strategy. In the long term, it will only depend on how they maintain their costs and contain them.
Thank you. And you?
Well, yes, I agree with them. I mean, if you are absorbing the cost, it means you want to push volumes. So in the short run, yes, this is achievable. It also gives them the competitive edge, because some compared to other companies that are actually putting pressure on the consumers. But I think this also depends with the cost structure and how they are managing their costs. Because once the cost pressures start coming up and the volumes they are not increasing to offset the cost, it will then mean that the company won't be actually making profits from that. But I think short term, yes, it's actually a good thing, because you are actually drawing customers, you're increasing your customer base. But in the long run, it's not sustainable.
Okay, thank you. On that note, we thank you, our viewers, for joining us today. And we do believe that you join us on our coming episodes. If you have different views, feel free to share your thoughts. We would like to hear what you think. So thank you for joining us. From myself, both of my colleagues here, and the crew behind the scenes, we do appreciate you for taking your time to get to hear some of our views on the issues that we discussed today. So on that note, please do enjoy the rest of your day and stay safe. Cheers.